Welcome to the deep dive. Today, we're really getting back to basics. We're looking at something absolutely core to business finance.
That's right, the accounting equation. It might sound simple, but honestly, it's the key to understanding, well, pretty much any business's financial health at a glance.
Okay, so let's just put it out there. The equation itself is assets equal liabilities plus owner's equity.
Exactly. Assets equal liabilities plus owner's equity.
And the crucial thing here, maybe the most crucial thing, is that this isn't like a guideline. It's a hard mathematical rule, right?
Yeah.
It always has to balance.
Always. No exceptions, every single time. Think of it like a scale.
Okay, so let's break down the pieces. Assets. What falls under assets?
Assets are basically all the resources a business owns, things that have value. So cash is the obvious one,
Sure.
but also things like accounts receivable, that's money your customers owe you, and physical things too, like land, buildings, equipment.
Okay, got it. Resources owned. Now, the other side of the equation starts with liabilities.
Right. Liabilities are the opposite in a way. They represent what the business owes to others to its creditors.
So, like debts.
Precisely. Things like loans you've taken out or accounts payable, that's money you owe to your suppliers for things you bought on credit. Obligations, essentially.
Makes sense.
Yeah.
And that leaves the final piece owner's equity. Or sometimes it's called something else.
Yeah, it depends on the business structure. For sole proprietorships or partnerships, you'll usually hear owner's equity. For corporations, it's typically stockholders' equity.
But the idea is the same.
Fundamentally, yes. It represents the owner's or stockholder's claim on the business's assets. You can think of it as the residual amount. What's left over from the assets after you've accounted for all the liabilities? It's the owner's stake.
Okay, so assets, liabilities plus owner's equity. O plus stake. Simple enough.
Mm.
But how does this play out in, like, day-to-day business?
That's where it gets interesting. Because every single business transaction affects this equation. But, and this is key, it always keeps it in balance. There are always at least two effects.
Always to effect. Okay, give me an example. What if the owner puts their own money into the business to get it started?
Okay, good one. The business receives cash,
Right,
right? So the cash asset increases.
right.
At the same time, the owner's investment, their stake in the business, has also increased. So owner's equity goes up by the exact same amount. Assets up, owner's equity up, balanced.
Okay, that makes sense.
Yeah.
What about buying something? Let's say the business buys, I don't know, a new piece of equipment using cash.
So cash, which is an asset, goes down because you spent it.
Uh-huh.
But you now have equipment, which is another asset. So the equipment asset goes up by the same amount the cash went down.
So you're just swapping one asset for another. The total assets don't actually change.
Exactly. So the equation stays perfectly balanced. Assets change composition, but the total is the same. Liabilities and equity weren't touched in that one.
Clever. Okay, what if you buy something but don't use cash? Like buying office supplies on account, on credit.
Right. So you get the supplies, that's an asset going up. But you didn't pay cash. You created a debt.
Yeah.
You now owe the supplier money. That's accounts payable, which is a liability. So liabilities go up too.
So asset up, liability up, balanced again.
You got it. See the pattern.
Yeah, I think so. How about earning money?
Yeah?
Say the business performs a service for a customer and they pay in cash right away.
Okay, cash comes in, asset goes up.
And what's the second effect?
That cash represents revenue earned by the business. Revenue increases the value of the business to the owner. So owner's equity goes up, asset up, owner's equity up. Balanced.
Right, because the business is now worth more. Okay, one more. Paying bills. Let's say paying the monthly rent with cash.
Simple. Cash goes out, so the cash asset decreases.
Down.
And paying an expense, like rent, reduces the business's profit and therefore the owner's claim on the assets. So owner's equity also decreases.
Asset down, owner's equity down. Still balanced. Wow.
It holds true for every single transaction, no matter how complex it might seem initially. It always breaks down into at least two changes that keep that fundamental equation equal.
So understanding this isn't just academic. It really gives you a framework for, well, seeing how money flows through a business and what state it's in.
Absolutely. It provides that snapshot, what the business has, what it owes, and what the owner's stake is. It's the foundation for everything else in accounting and financial analysis.
Assets equal liabilities plus owner's equity. It seems so basic, but it unlocks quite a lot.
It really does. It's the bedrock.
So here's something to think about. If every transaction, even really complex ones, just boils down to shifts in this equation, What stories can you start to see? Can you track a company's big moves, its risks, its growth, just by watching how these three pieces change over time? Definitely food for thought. Thanks for joining our deep dive today.